outlook for the US economy has brightened somewhat thanks to some improvements in the jobs and housing market and policy action in Europe. But is the US economy genuinely back on track, or should markets anticipate further setbacks? Well, joining me now is John Hancock from the World Trade Organization in Geneva. John, thank you very much for coming in the studio.
Thanks for inviting me.
Now, one of the key questions which highlights both investor and policymaker concerns is further quantitative easing necessary, and more importantly, is further quantitative easing actually the right remedy to sustain US recovery?
It's a good question. I think it's fascinating to watch the political debate in the US right now in this Republican primary process, because quite clearly there's a policy struggle at the heart of the United States. On the one side, those who say we need more quantitative easing, we need more government intervention in the economy to ensure that this fragile recovery takes hold. And on the other hand, those who say if you have a toothache, Novocaine isn't the only solution. At some point, you have to undertake a root canal. And all of this liquidity in the market, all of these government interventions are delaying the inevitable restructuring that has to take place. This policy debate hasn't been resolved.
So what side of the debate do you sit on?
I'm on the latter.
Yeah?
Yeah, I think the game has changed since the financial crisis in 2008. Then it really was a confidence problem and the danger that there was going to be some kind of liquidity contraction and fear would set in. Now it's a restructuring problem, and the United States is an extraordinarily resilient economy and a very adaptable economy. Are the interventions helping that adaptation, or are they hindering it? And I think they're hindering it.
Now, there are quite a lot of downside risks which pose a threat to the US stability, including Europe's woes. We've got a slowdown in China and, of course, higher gasoline and oil prices. What other factors are ringing alarm bells for you, both in the short and long term?
Well, I think the United States domestically isn't entirely out of the woods. I mean, a month ago, the GDP figures were up, the unemployment figures were better. I think they added 700,000 new jobs in the last quarter. Consumer confidence was up. This week it was a little less certain. The housing market is down further, the lowest level since 2002. Consumer confidence is not fantastic. So it's not as if the domestic picture is completely certain. And I think you're absolutely right to highlight the international risks. All of this quantitative easing, this money printing, doesn't just have implications for the US economy, it's flooding globally. And right now, for example, in the World Trade Organization, a debate is going on as we speak about this, what the Brazilians have called a threatened currency war, the impact of devaluation on Brazil, on other developing countries, the uncertainty in the Chinese-US relationship on currency. So yeah, there's outside risks, there's no question. Are they decisive? Davos, the recent Davos meeting, the participants all seemed to think that capitalism was doomed and that the West was going downhill. That's probably a good leading indicator for a world that's on the edge of recovery, in my opinion. So I don't think we're out of the woods yet, but the trends are good.
What's your take on the jobs market? Now, the unemployment rate in the US has fallen nearly a full percentage point since the summer to 8.3%. What are some of the reasons behind this unexpected decline in unemployment? And is recovery fully here, or could we expect another downturn ahead?
I think the job market picture is positive, and probably more positive than even the numbers suggest, because these aren't jobs that are short-term job creation programs at the state level or the federal level. These are largely private sector jobs, and it reflects the fact that there was a pent-up demand in the economy, and the period of uncertainty is now easing somewhat, so companies feel more comfortable taking on employees. I think it's also a sign that this kind of restructuring we were talking about earlier, it's following its course, and then it's to be expected at this point in the recovery that unemployment will start to pick up. Of course, the other side of the unemployment picture that is rarely mentioned is that there's huge job shortages in the US market as well. I mean, as companies downsized and shifted focus, equally, tech startups, engineering companies, jobs in computer services are looking for trained staff. So America has an underlying, not just an unemployment issue, but a structural labor market issue.
Okay. What about the US housing market? Now, obviously that's a big, hazy outlook for the US economy. Now, the slowly improving jobs market and, of course, record low mortgage rates have helped improve the property sector somewhat. Are we starting to see a mend in the housing market, or are prices stabilizing finally, or not?
That's the $64,000 question, isn't it? So much of this hinges on the housing market. The crisis hinged on the housing market, and now 4 years later, we're still talking about the housing market. And the recent numbers aren't particularly good. If you look at this famous Case-Shiller index, it's declined the last quarter. We're still seeing a general downward trend in housing prices. When will it hit the bottom? It's anyone's guess. And bear in mind that banks now hold a sizable share of foreclosed houses on their books, which as soon as the market turns up, they'll let that loose on the market, which will also keep prices depressed. Having said that, again, when this shift occurs, I think it will occur quite quickly. And the fact that it's darkest before dawn, we're at 2002 levels, there's pent-up demand in the housing market. My guess is that when it turns, it will turn quite rapidly. And then you'll see things like fairly rapidly improving consumer confidence. The unemployment picture will be better. But you're right, it all hinges on housing.
Now, in regards to consumer confidence, consumer spending, as we know, accounts for around 70% of overall economic activity in the US. And of course, the Fed are desperate to boost consumer and business demand. In what ways do you see that the Fed can promote this?
Again, we're back to this basic policy question. Do you do it by intervening and trying to build confidence, or do we assume that some of this requires a certain level of pain? You'll have a fairly solid argument to say that it's the continuous uncertainty about what the Fed is going to do or what it's going to do next, which is destabilizing choices and making it harder for consumers to predict future employment trends, future interest rate trends, whether they should now finally jump back into the property market and buy, whether they should purchase that new car or hold off for another year. Certainty is really important, and right now the very fact we're asking these questions shows there's a large question mark out there.
John, thank you very much again for coming into the studio. A very interesting point to end on there.
Thanks for having me.
So there we have it, John Hancock from the World Trade Organization in Geneva. Now, for more exclusive interviews, stay tuned to DukasopyTV. But for now, goodbye.